Welcome back to Vantage. I have a veteran fund manager back on the show today. She has been on before, but she's launched a new fund about 3 years ago. It's the first time we're revisiting her with the launch of the new fund. She focuses on UK high quality companies. Let's go take a look. Welcome back to Vantage. Delighted to have an old friend of ours, Rosemary Banyard, who is back in front of the Edison cameras. Rosemary, welcome back to the show. For those, I mean, a lot of people know you, but for those who don't, maybe just touch on your history in terms of fund manager, and then ultimately culminating on, you know, what brought you to the VT Downing Unique Opportunities Fund.
Yes, yeah, nice to be back, Neil.
Thank you.
So I started life in the city on what's known as the sell side, and I was a company analyst, sector analyst for about 12 years. And then I started to think, well, I'd quite like to make my own decisions about investing rather than tell other people what to do.
Yeah.
But I thought, well, I'll get a qualification of some sort. So I went off and did an MBA, had a couple of children during that, and then came back as a fund manager in a small firm called John Gavett. And then after about 2.5 years, I got a phone call from someone that people will know even better than they know me, which a guy called Andy Brough at Schroders, who said, you know, can we have lunch? And the upshot of that was I went to Schroders and worked with Andy for 18 years. And we built a pretty big business actually in basically UK small and mid caps. And at that point I thought, well, you know, we have a lot of different funds, a lot of holdings, and I'd just quite like to change and have my own fund that I launch and have it much more focused and just do something completely different. So I left Schroders. I had one slightly false start, and then about 3 years ago I joined Downing at the suggestion of a financial advisor who had invested with me, who said, I know they're trying to build up a fund management business. So I met Judith McKenzie, who's heads it up, and joined. And then I launched the Downing Unique Opportunities Fund. We're coming up to the 3rd anniversary. Yeah,
timing was interesting because I think you almost hit the market bottom. Is that right when you launched?
It is. It was obviously complete luck because it takes some weeks to put together a prospectus and get it through the regulator. Yeah. We were within a week of the market bottom after the COVID sell-off. Yeah.
Okay. And look, I mean, you know, it was interesting sort of reconnecting with you it sounds like you found a home that you're happy with.
Yeah.
Tell us a little bit more about the fund itself in terms of the market cap ranges you operate in, the investment philosophy, how many holdings you typically have, and what you're trying to achieve.
Yeah. So it's deliberately quite focused. So the potential range is 25 to 40 holdings, and at the moment there's 32. There's a couple of size constraints, so it's UK equities, but I don't invest below about 150 million market cap, so I'm avoiding micro caps.
Yeah.
And that's for two reasons. Firstly, Downing do that elsewhere, but also in an open-ended fund, I don't want to encounter too many liquidity issues.
Yeah.
You know, it can be challenging. But I also decided to put an upper limit on, which is about 10 billion market cap.
Yeah.
And that roughly takes out the top 50 in the FTSE 100.
Yeah.
And the reason for that is that I've got a certain style. There are other funds out there with maybe similar philosophy and style, but they typically do mainly invest in those very large companies. So I wanted to do something that's sat differently from that. The philosophy is, firstly, the very first question to ask is, would I be happy to own the whole company? Because that's an interesting test of quality, actually.
Yeah.
So if the answer is yes, you know, fine. And if it's no, well, then why are you buying even a slice of it? Really? But the big thing is that I'm looking for good returns on equity because I'm an equity investor, but without much debt. because of course you can boost your return on equity by leveraging
Leverage,
up huge, and that's what banks do. So I basically want companies with above average profit margins and good capital turn, so that they're generating huge returns on their capital, and that's my hunting ground. So it's quality above all else.
Yeah, and you can do you measure yourself against a benchmark? No benchmark. How do you go about it?
So the official prospectus is no benchmark. It's a 5-year view, and looking for total return, positive total return. I'm sat in the all companies sector of the open-ended categories, which means I'm sat against a lot of funds that have a lot of FTSE 100 companies. So it's not a perfect place to sit. So what you find is when you look at performance against the peer group, it's either you go from hero to zero depending on whether people like small and mid caps or whether they're favouring FTSE 100. So, but it's interesting. There was a sort of passive fund launched in July 2020, so 4 months after me, and since it launched, and this is a mid and small cap passive, they're up I think 6.5%, and I'm up 24%. So I kind of feel that's a better measure than how I'm doing against someone who owns tobacco or pharmaceuticals or oil. Big oil.
Okay, and I mean you hinted at you're looking for great quality companies. It's almost Warren Buffett-esque. Would you be prepared to own the whole company? But what are the traits, the measures that you use to gauge whether you're looking at something which is a high? What gets them to cross the bar?
So the bar is interesting because when the prospectus went into the regulator, they came back with one question really, which was, what do you mean by the word unique? Follow-up question, are you the only person that can invest in these stocks? To which the answer of course was no, because they're all listed. So anyone can invest in them if they choose, and it meant that we had to really specify what we meant. And so there are basically three things. The first was an above average return on equity without much debt over a fair number of the last 10 years. So if a company didn't achieve a good return during COVID, that's fine. That was pretty exceptional. The world sort of stopped. But you'd be looking back and saying, has this company generally achieved above average returns? Now, the market achieves in the UK about 14%, and this fund currently the average is over 30. So that's a mathematical kind of assessment. The second question is, well, why are they able to do that? Year after year, it must be because they've got things that keep the competition out. So what are those attributes? And I categorise them into different things. So it's either going to be patents or regulatory protection, or it's going to be being the leader in a network, or it's going to be high switching costs, which is typical with, say, software companies. It's really painful to switch. Or it could be a unique asset or a very sustainably low cost base compared with your peer group. So the second thing is, what is it? Let's identify that. And usually it's not that difficult. And then the third question, which is sort of the uniqueness, is, are they the only one listed in London that does what they do? Well, that's yes or no. If there's more than one, then what is the very distinctive strategy, culture, attributes that really set them out? So, an example I give there is Gleeson. Lots of house builders, but Gleeson is very different with its strategy because its target market is a couple who are both on the national living wage, and there is no other listed house builder that attempts to get to that market.
Okay, interesting.
So that's it. And every time I buy a new holding, I have to actually send a note to compliance first saying, this is.
Okay. So I think that's pretty good, and then I think a lot of those are sort of things that we'd expect. Now, you once, I always remember this, you told me that, look, if I can't summarise why I own a company in a sort of couple of sentences, you probably don't actually understand why I'm owning it. And I think you do it really, really well. So I would love you to just walk us through, some highlights in the portfolio in terms of things that have fared well and perhaps things that you own which, need to recover or have had issues.
Yeah. So that skill set and that revelation came from actually running pension money, where we had to write quarterly reports, and I had to put a paragraph in saying why I'd bought something.
Yeah.
And if you couldn't just write it straight away, it was quite telling, actually. Yeah. So if I look back to last year, the best performing company in my portfolio was one I think you know well, which is FOUR.L.
Oh yes, yeah.
Actually, it's very interesting. I was just exchanging texts with someone this morning, and he said he'd bought FOUR.L in 2009 and sold it having made 100% profit. Mm-hmm. And he said if I had held on, I'd have made 33 times my money. Yeah, which is the whole point. An
extraordinary business
about compounding.
Yeah.
So what is it FOUR.L does, and why is it able to do this? So it has a very small share of a very big market in America. The market is corporate promotional goods, so the T-shirt, the pen, the mug, or whatever that's got the logo on that you want to give out at a conference. So they procure those things, procure the printing, and they do so for lots of small and medium-sized businesses in the States, because there are thousands and thousands of these companies. Yeah. And they are incredibly efficient, well-honed machine. I think it's interesting. They have a good culture. Why do I say that? Well, they're in Oshkosh, Wisconsin. Yeah. And they in COVID they didn't sack anybody, even though it was painful. Yeah. So they have a very loyal workforce in a smallish community. That's important. Mm-hmm. They also give incredible guarantees, as in if your products are not delivered on time, you can have your money back. Yeah. Now you don't do that unless you're pretty confident of your back office and your abilities. And they have a great support staff, and it's just quite a machine. It's quite capital light. There's I think they have 2 or 3% market share. Lots to go for. Yeah.
That's look, it's one of the certainly stands out in terms of one of the best performing stocks of the last decade, and we've been covering it for a long time, so know that. How about some of the other things that haven't fared well, or other things that you're catching your attention?
Yeah. So that was the best performer last year. The worst performer was something called Mortgage Advice Bureau. Mm-hmm. And that's a platform business, and I like platform businesses because they bring together with technology lots of buyers and sellers, and if they're a market leader, that's a very virtuous circle. Yeah. And Mortgage Advice Bureau are, I think, the market leader in mortgage advice, mortgage advisors, and putting advisors in touch with leads. So this is people who either want a new mortgage, or they want payment protection insurance, or they want to refinance a mortgage. Yeah. And they've got a whole raft of advisors all over the country that are linked into their system. And they do provide them also with compliance capability and training and things that they need for regulatory reasons. They also provide leads through deals with people like Money Supermarket, so they'll sort of funnel some of their interested parties to various advisors, depending on the geography. So a classic sort of leader in a network type company. There's one quite simple reason why they had a really bad year, and that was Liz Truss. So the unfunded sort of Kwarteng budget, sent the gilt market haywire, and it sent interest rates up, and a whole load of mortgage products were withdrawn. Yeah. Obviously, consumers got cold feet. So there was a rush immediately for those who'd got an offer to complete.
Yeah.
And then Christmas came early, and that wasn't a positive in this case. Christmas came early, and that things went very quiet.
Yeah.
And I think things are just starting to open up. But I'm sticking with it because I can absolutely see that was one of those extraneous factors that, actually pretty difficult to foresee.
No.
And it will slowly recover because it's in the interests of any government to have a healthy housing market.
Okay,
Yeah.
That's good. I think that illustrates it nicely. The idea of investing in high quality companies, and I read your sort of recent piece about, I can't remember the exact
Can you bear
title.
to wait?
Yeah, can you bear to wait? Where I thought, it was illustrating this sort of power of compounding. I like getting to know the people, and I think you've got to be a patient investor. Give us a couple of traits about yourself in terms of what describes you as being patient.
Well, I'm not sure that my husband would say I was always very patient. Actually, so it's rather interesting, isn't it? I think it's something that's born of experience and confidence, and knowledge is cumulative, I think. So you get to know these companies better and better over time. So you hopefully your ignorance is reducing, and that enables you to be more to take the longer view, because you know who you're dealing with, and you've been dealing with them for a long time. So instead of looking for the things that maybe a lot of other people in the market look for, such as has it gone up a lot this month, therefore I might sort of trim it. Are they still true true north on their strategy? Is the management still doing what they're doing? Is there any reason to worry? And if there isn't, I think stick with it. So I think that's a big thing. I read quite widely, and I listen to a lot of investing podcasts, and some of the great investors are always urging that the best thing to do is to the advantage is if you can take the long view. Yeah,
do little.
do as little as possible.
Yeah. And look, I mean, I recently did a series with someone who does a sort of similar kind of approach of international small cap investing, and Mark Fisher sort of spent a lot of time talking about the fact that actually that strategy has lagged over the last 3 years for a variety of reasons. And I know, looking at the fund, it launched at £1, it soared, it's soared. Come back a little bit. So there's a little bit of, but overall you're ahead. But what gives you faith that the market is going to get back to, for want of a better word, looking at fundamentals and rewarding companies that deliver excess returns?
Yeah. So there's at least a couple of things. So Charlie Munger, incredibly bright, insightful man. He once said it's difficult in the long term for a stock to perform better than the returns that the company itself achieves.
Yeah.
And I think that is very profound. So in the short term, you might buy something and you're buying it, let's say, cheap or dear compared with its intrinsic value, and so you might make a gain or a loss depending on how that pans out or how the market's trending. In the long term, a company that's compounding up its asset value, equity value, at say 15% per annum, eventually the value of the company must in some sense track that. It might be that it sits at a discount, because it's unlikely actually if it's got that kind of a compound. But if it sits at a premium, the premium might vary. But over time, if that keeps going, it will track it.
Yeah.
And if you are invested in a very low return business, you'll find that business can't keep investing. It's got to raise money from the market
Yeah.
in order to do that, and its returns will be a lot lower, and you'll find your stock returns will be lower. And I kind of agree with them. The logic is entirely there.
Yeah.
And I think the other thing is these businesses are prodigious cash generators usually because they're quite capital light. And so that gives them huge optionality. So you'll get, special dividends. So, Dunelm, another one announced today. I think they had one last year.
Yeah.
Not everyone was expecting one again this year, but gone and done it. So you've got that. You also can go and make acquisitions if you want. And if you think about the environment we're in now, kind of on the edge of recession, some sectors in recession, and there'll be business failures, there'll be highly leveraged businesses that have to sell things off.
Yeah.
Who is going to be in a position to clean up on that? Well, it's the companies that have got cash, that have got the cash generation. They can just go out there and do that. So you find in these situations the strong get stronger, and so I think it's a question of time.
Yeah. It's a sense of gravity. Eventually, the market will find its feet with that.
Yeah.
Okay. Curious, particularly in light of what I talked about, which is that there has been some elements of thematic investing over the last 2-3 years, which has moved people away from fundamentals. Within the portfolio that you started the fund launching, are there any noticeable sector tilts or themes that you're playing, or is it you just focused on high quality companies?
It is the latter, and there's been very low turnover. I think since launch it's 11%.
Yeah.
So this was pretty low. And there are certain sectors that, because they don't deliver sustainably high returns, I don't tend to invest in them. I mean, restaurants would be one example, in my opinion. So the changes that have been made, there's are largely to do with that focus I said on is the model changing, is the focus changing. So usually it arises because somebody goes and makes an expensive acquisition, possibly in an area that they might describe as close to what they're doing, but it turns out to be not such a good idea, or they've paid too much. So, for example, I sold Avon Rubber out, Avon Protection, which is now down 2/3 from that level because they got into body armour, which actually turns out to be not nearly such an interesting business as gas masks. And I sold Aviva, the software business, when they paid for a very expensive US acquisition, and they came down a long way. They got bid for, but at a lower price than I'd sold. So it's usually around that I'm selling. I don't take macro views. I can't tell you, Neil, what interest rates are going to be next year, the dollar, the oil price. I want to own companies where that shouldn't hopefully matter too much.
I think you've got to decide where your edge is and what do I do better than the market. And I said, there is a sense of, look, I have the experience of assessing a company in terms of, is this better than its competition? Is it a high quality company? I think that resonates really strongly with me. How do you discover new companies then?
Yes, well, so one of the merits of having been at Schroders was it's a big investment house, and every company on the planet, wanted to come through the door. So I come from a background of knowing an awful lot of businesses and having known them for years. Of course, there's new arrivals, and that's a good thing. I use some screens, just basic screens for the parameters that I've outlined. And I just keep an eye out, and I prepare models to look at and understand the history of quite a lot of companies. And there'll be quite a few that I'll look at that superficially might look interesting, and then you do the model and you think, well, actually, that one, the returns are declining, or the margins are under pressure, or there's something that you don't like. So it's quite a high bar actually to get through that process. But it's keeping your eyes and ears open and just looking at a lot of businesses, and then looking in more detail at the ones that that measure up.
Yeah.
Yeah.
And you will then go on to meet them and meet with the management team.
Yeah.
And,
Yeah.
Okay.
So I mean, I won't tell you who it is, but so you know, this morning I saw a company that I think I met them on IPO a few years ago and didn't really understand it and didn't invest, and actually they've proved themselves over quite a few years, and so I've done a model. It all looks fine. The shares happen to have halved in the last 3 years, which is a common feature for quality.
Yeah.
So they're into my sort of price range, which is DCF based. So I met with them this morning to go through sort of an understanding the business type thing, and then I'll probably I won't rush with these things. Take my time to get to know them.
Yeah. Okay. When you're looking at, I mean, you touched a little bit about the fact that you want to be different, that you're in, let's call it small and mid cap rather than large cap. What's the case for, small and mid cap outperforming large cap? Because I've been doing this a long time, and I think what's noticeable this year is that for a long time there was never any launches of small cap funds, and then suddenly there's been a space of them coming out. So it looks like an interesting sort of time in the market.
Yeah, I agree. Of course, so there's various things. So the number of small companies has shrunk and shrunk in the UK. It's very sad and slightly worrying development, really. But it means they're more scarce. Yeah. Which usually is good for valuations generally. So there's been a lot of takeovers. Yeah. And I think there will, be more actually in the year ahead. So even in the closing, months of last year, when we've got all that uncertainty about interest rates and inflation, and we still had, bids for Devro and Dignity, and it's just carrying on. So that I think is always there. I think what I alluded to, which is that strong companies will get stronger in this, there are some really interesting niches, frankly, where you don't have to take a view on the oil price or interest rates, let's say, or currencies. There's trends such as reshoring, which could help local businesses. Yeah. But I think it's as much around the fact that these things have come back a long way, and they really don't look expensive now relative to what they're capable of. Yeah, and I think that there's a growing chorus of if you take a 2-3 year view, this is a great time to be looking at these kind of companies. Think so.
Yeah,
I do think so.
All right. Final question. Given how long you've been looking at financial markets, and particularly in light of the audience who tends to watch this, what advice would you give, someone at the latter stages of education in terms of, what bit of financial advice, educational advice would you give to them in terms of looking at the financial markets? Yeah, it's a really important thing that we get the next generation interested. As an aside, I'm a graduate of Clare College, Cambridge, and a famous fund manager in Asia actually gave them some money to launch a fund run by the undergrads there, and they were the women undergrads. Yeah. And so I do go in and talk to them and help them when they have competitions. So I'm keen to encourage more interest. I mean, it's challenging because young people have got something I never had, which is they've got student debt. Yeah. And so they're not really thinking about investment. They're thinking, about paying off the debt. Yeah. And then after that, then they're going to be turning to thinking about how do I afford a place of my own. And whereas I might have been thinking about that in my 20s, they are probably going to be thinking out about that, if they're lucky, with the bank of mum and dad in their 30s. So there's a lot of things that are distracting them from the investment world in general. But I think encouraging reading widely. I think it's podcasts. There's lots of them. I mean, even if it's at the level of sort of personal finance and sort of Martin Lewis or whoever, it's just
And I am a great believer in people having a reasonable understanding of both statistics and things like compound interest. Now, I got that quite late. I got that really with my MBA. But I would, be encouraging, actually even younger than you're saying, I'd be encouraging people in school to go and do at least a maths A level if they can do it.
Yeah.
Because, Einstein, famous quote that compound interest is the eighth wonder of the world.
Yep.
And if you understand it, you earn it.
Yeah.
And if you don't understand it, you pay it.
Yeah.
Fabulous quote, actually.
I think that's right, and I think I will include a link to your article, because that is, if I look back with hindsight, if you'd understood that in your 20s, it would have transformed the way you sort of saved, etc.
Yeah, and it is deeply unhelpful that social media encourages short-term trading, actually, because everyone's sort of talking about what they're doing at the moment, and it's trying to counteract that and get people to think longer term.
Rosemary, it's been a pleasure having you on the show. Thank you very much for watching Vantage. Great to get another manager who's focusing on high quality companies coming and talking to us about it. I hope we can track Rosemary's performance for you over the sort of coming years. Look forward to you guys tuning in next time. Thank you.